Hello, chart watchers, and welcome to this Friday, April 5th, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Take a look at the market. We got the jobs data out this morning. The Dow Jones Industrial Average was up a little bit more earlier, but still up 21 points. The S&P 500 up nearly 10, within about 1 2/3% of its all-time high. The NASDAQ up 39 points today, and the Russell 2000 near its high of the day, currently up 12 and leading on a relative basis. 10-year Treasury yield, talked about that 20-day moving average and 2.55% yield resistance being a problem. With the jobs report, we got right up there, turned around, and have come back down. That'll be worth watching into today's close. Volatility index was down in the low 12s earlier today. When we see readings down here at this level, typically that accompanies a bull market advance. Energy prices, you can see, crude oil has been going through the roof. Energy, talked about this a couple of days ago, showed the positive correlation between energy and crude oil prices. But recently we had pulled back on the XLE. Thought we might see a bounce off the 20-day. That's exactly what we've gotten. We're now breaking out on the XLE. Healthcare also having a strong day. These are the two leaders. Last time I checked, all 11 sector ETFs were higher today. Leading in the energy space, we've got exploration and production stocks. Once again, trying to come up and challenge 670 or so. That's been a difficult area to get through. Also, we have oil equipment and services stocks having a very strong day today as well. Two stocks leading the S&P 500. These are exploration and production stocks, Apache and Anadarko, both up 4 or 5% on the day. And you can see Anadarko actually breaking to about a 2-month high. Okay, Mary Ellen, first of all, this has been a big week here at StockCharts. We've had a week-long anniversary celebration. Welcome to the party.
Thank you. It's been amazing to watch from afar, and I'm super excited to be here today to be a part of it. It's really been quite lovely, quite extravagant.
Yeah, and we have had a series of guests this week like no other. It's been, we started with Arthur Hill at the beginning of the week, and of course, Chip started us off with a video that kind of really went back and walked everyone through 20 years at StockCharts and many of the things that have taken place. And we've gone through a number of key guests this week, and we've got another great guest in John Murphy, who's going to be in here in just a minute. But first, before I bring John in, I want to bring in Chip Anderson, president of StockCharts. Chip, this has been a big week.
Hey, Tom. Hey, everybody. Welcome. Thanks. Yes, it's been a wonderful week. 20 years kind of flew by from my perspective. I'm always focusing on the future. And in just a little bit, I'm going to be sharing my vision of the future with everybody. And got some pretty exciting announcements, too.
Awesome. And one announcement is going to be that in about 15 minutes, we're going to get a great presentation from John Murphy. John, how are you doing today? And welcome. This is your first time on Market Watchers Live. Welcome.
It most certainly is. And I hope it's not the last. So I'd like to say hello to you, Tom, and Mary Ellen, and Chip, and everybody who's listening in. I'm really looking forward to this.
Yeah, we were joking a little bit before the show, John, but this is your audition, to see whether or not you get an extended contract here.
They haven't signed anything yet.
Well, we'll see how things go today, but I'm sure it'll be just fine. Stick around, though, because John Murphy is going to be back with us in about 15 minutes. And I know Chip's got some announcements later in the show, so you do not want to miss today's show for sure. But let's go ahead and get started because we got a lot packed into today's schedule. Upcoming schedule, first of all, next week, Tom's workshop. So I will be coming up with something, not quite sure what, might have something to do with relative strength, especially as the market continues to strengthen. I think that could be a timely topic. Then on Wednesday, we will have Tony Dwyer joining us. And then Thursday, Roman Bogomazov will be back on Market Watchers Live. So pretty busy week ahead as well. Today's agenda, of course, there you go. You got John Murphy coming on at 12:20. Chip Anderson will be back with us also, and he's going to share some exciting news going forward with StockCharts. Of course, this past week, we've talked about a lot of what's happened over the last 20 years. And reminisced about a lot of, how folks have gotten involved with StockCharts. But Chip's going to have some interesting stuff for us in the future, so that you don't want to miss that. And then we'll finish with an abbreviated version today of what's hot and what's not. So let's go ahead and get into it. We do have economic news. I believe there was one somewhat important report out this morning. March non-farm payrolls. If you recall, February payrolls came in way below expectations last month, kind of spooked everyone with about a 20,000 job reading. That was revised slightly higher, but you can see the March non-farm payrolls look much better. 196,000 versus the 170,000 expected. We had private payrolls come in above expectations. The unemployment rate unchanged, 3.8%. And March average hourly earnings came in below expectations. So we got a good solid jobs report showing moderate growth. And then we've got very low wage inflation. So this is a pretty good market environment for stocks. And of course, the Fed, which was much more hawkish back in the fourth quarter of 2018, has now turned more dovish. And the bond market was sending that signal to the Fed, and I think the Fed heard it loud and clear. Let's take a look at that 10-year Treasury yield. Here you can see that back in November, we had a double top up near 3.25%. We have been downtrending ever since, and it was back in December that the Fed came out and said, well, you know, we're kind of paying attention to what the bond market's telling us. We thought we were going to have multiple rate hikes in 2019, but we have now decided that we don't really see any in 2019, maybe one in 2020. And there's actually been a lot of rumors now that maybe we'll even see a rate cut before we see a rate hike. Of course, we'll have to wait and see whether or not that transpires. But we did seem to get a bottom in the 10-year Treasury yield just recently, bounced back up. Two levels I was watching on the yield was that declining 20-day moving average, and then also the support, the yield support that we saw back in January at 2.55%. Getting back up through that level might take a little doing as well. But we got up to 2.544 earlier today. We've reversed back off of, we're now currently below this 20-day moving average. So I think we've established a range now, short term, 2.35% to the downside, 2.55% to the upside. And let's see which way we break. Keep in mind, if we break to the upside, that is telling us money is rotating out of treasuries, and that can be certainly an advantage for the U.S. equity market as we go forward. So it's going to be worth taking a look at. Okay, I'm just going to jump in and take a look at some relationships of the sector ETFs versus the S&P 500. So let me go ahead and pull those up for you. I think that this is a really important way to address the market. There really weren't any earnings news out to go over today. So I thought I'd jump right in and take a look at some of these sector ETFs and compare them to the S&P 500. So when you're looking at this chart, this goes back to, well, last 5 years, back into 2014. And as you're looking at this, this is not telling us that the technology ETF is going higher, even though it did. It's telling us that the XLK is outperforming the S&P 500. Now, I look at the PPO. I do tend to follow the PPO, even though this is a price relative chart. I like to see what the momentum is in this price relative indicator. So as the price relative is moving higher, you can see we get movement to the upside in the PPO. I would like to point out, though, here that technology has been the best performing sector in 2019. And you can see that the relative PPO now has pierced that one level. And when we go back the last 5 years, when technology gets to a point where it's outperformed for that extent, that long a period of time, and to that extent, and we see the PPO, the relative PPO, get up to 1, we generally see the technology group back off. It doesn't mean that we're going to go down in technology. Just on a relative basis, some of the other areas tend to strengthen at the expense of technology. So I would not be surprised to see the next quarter, and I'm bringing some of this up because if you look at today's poll, we're asking you to go back and look at the 5 aggressive sectors and tell us which one you think might outperform in the second quarter. I personally don't think it's going to be technology, just because we've already had such a run. We got a lot of positives built into this group already. And so I wouldn't be surprised if the group just kind of goes along for the ride with the S&P 500. I don't know that we'll continue to see significant outperformance here. So let's move on to the next group, consumer discretionary. Again, 5-year relative chart. But notice on this chart for the last 2 to 3 years, well, actually for the last 6 to 9 months, it looks very similar to a period that we had that spanned about 2 years from 2015 to 2017. when consumer discretionary just kind of went along for the ride with the S&P 500. Then we broke out in early 2018, and I think we're consolidating and just breaking out again. If you look at the relative momentum, the PPO here, you'll see again that when we get up to about that 1 level or just above, that's when we tend to see the relative strength subside for a period of time. We're not there yet on the consumer discretionary. I think momentum is still accelerating in this group, and this would be one of my 2 picks that I'm looking for, maybe for some significant outperformance in Q2. Next up, communication services, the XLC. I actually think this is one you want to keep an eye on because we have not been doing much over the past 6-7 months, and money rotates. It rotates between major indices. It rotates between our sector ETFs. And so I think the fact that we have been pulling back, holding the prior lows, and starting to turn back up again, and the relative PPO is sitting right on the center line. This is a group that if we get a breakout, especially on a relative basis above that 0.017 line, I think this is an area of the market that could seriously outperform. So keep an eye on communication services. We've started to see some strengthening in the internet stocks. I would keep an eye on a couple of those areas within that sector. Next up is the financial area. Now, financials have been underperforming for a while. We've had a lot of pressure on the treasury yields. We've seen that yield curve narrowing, getting very close to spread, getting close to zero. If you're looking at the short-term 3-month treasury yield, it's actually inverted. So there are some negatives with the financials. However, if you notice, the relative PPO is at -1 and starting to turn back up again. This has been a forgotten group. And if the 10-year treasury yield does make that breakout above 2.55% and continues rising, this is a group you want to keep an eye on. Finally, among the aggressive sectors, industrials. I think, again, industrials, and we could go back 10 years and look at the entire bull market. But what we tend to see in all of these aggressive areas are higher highs and higher lows on a relative basis. So yes, industrials, financials have been lagging for a while. Industrials currently near that center line. I think this one is similar to financials. We want to watch because they do, when we get on a roll, we can outperform for a period of time. Right now, it's just kind of neutral for me. Just a couple more quickly because the XLRE, this is real estate. And of course, everybody's excited because real estate's been strong. But I just want to keep it real here. Real estate goes through periods where we get outperformance, and then you can see 2016 through early 2018, very strong underperformance by real estate. So I think we just topped on a relative basis, hitting the April 2017 relative high. This is a group I'd be careful with, especially if we start to see yields moving higher. And then the last one I wanted to mention was utilities, because utilities, I think, have already started to weaken. Anytime we get the XLU up into the +2 range on the relative PPO, normally it's associated with selling in the stock market. Money rotates, utilities much more defensive. You can see back in the latter part of 2015, early 2016, if you recall, the S&P 500 was very weak back then. Same thing for the Q4 of 2018. So the market was weak. I think because of that, a lot of money rotated into the defensive utilities. But I think you got a couple things working against utilities going forward. Number one, I think we're in a bull market. I think that the cyclical bear market ended back in December, and I expect we're going to break to new highs, just my opinion. If that's the case, I think you see money continue to rotate away from utilities. Secondly, our 10-year treasury yields going much lower than they've been. If yields start to rise, I think that's another headwind for the utility group. Okay, Mary Ellen, I know you have some interesting topics for folks today. What do you have?
Yeah, so today I'm going to share with you what has been going on this week and significant shifts in the market that are going on and ways that you could potentially capitalize on that. So this week it's been all about China. China has come in with some strong economic numbers. We're seeing a number of the Chinese ADR stocks really pop, but also the talks as far as the US-China trade talks do appear to be getting closer to a resolution, and that has a lot of people excited. And one area that is going to impact not only the US but China and around the world, is this new what's called 5G network. And that is going to be the 5th generation of wireless technology. It's going to provide faster downloads, outstanding network reliability, all largely operated in the cloud. It's really going to transform numerous industries across all platforms. And I'm pointing that out to you because China is expected to be a real leader as far as the need to have technologies that can really embrace the data that's going to be really passing through quickly. And with that, there are a number of technology companies that have a lot of revenue source coming from China. So we need to have that talk in place, as well as the infrastructure to set them up so that they can have this fast streaming data take place. So what we're looking at here is a weekly view, a sector summary for this week. Materials are doing really well. Of course, that would be China related. The communication services sector fund, a lot of Chinese internet stocks in there. But let's go down to technology, because this new 5G network is going to be a lot of technology-based companies in here that are going to be helping create the necessary networks and also provide the computer chips so that this data can be transferred very, very quickly. So what I'm going to do here is go into the semiconductor stocks, take a look. They're up 5% this week. And a lot of it has to do with this new 5G network, as well as China related. So what I'd like to do here is we're looking now at a list based by performance for this week so far. I tend to like to sort this list by market cap, and that's primarily because I do tend to like these higher liquid stocks. And we can drill down from here with this scooter rating, and maybe John Murphy can give a little more insight on this in a bit. But this scooter rating is the StockCharts technology rating. It's an incredible rating because you want the higher the number, the more technically sound that particular stock is. So we can simply hover over the ticker symbol, and you can see this is Advanced Micro Devices, AMD, forming the right side of the base, looking very, very attractive. So we can drill down, and your better candidates are going to be up here in the forefront. But there are times when you may want to drill down a bit. Some of these stocks that are up and have these higher numbers may be a little bit advanced. What we can do from here is drill down and take a look at some of these other stocks that are going to benefit quite nicely from this move to the 5G network, and with an eye toward those companies that have high, there we go, that have a revenue source that's pretty large coming from China. I think Intel would be a prime example. Here we're looking at a daily price chart of Intel. We can see the stock is moving quite nicely this week, hitting new high in line with other semiconductor stocks. And Intel is, they're an end-to-end 5G services and solutions provider. They have 24% of their revenues derived from China, and they are all about the Internet of Things and driverless cars. All of this is very much in line with the anticipated rollout of 5G networking. And here we're looking at a weekly base. We can see that the stock hit a peak in price last summer and is now forming the right side of a base, poised to break out of a very lengthy 8-month base. So if we do get that breakout on volume, we can expect Intel to continue to matriculate higher. And I'm going to go ahead and leave it at that so that we can move things along. So that's all I have for this Friday.
This has been such an exciting week with so many wonderful guests, but we are about to move into the finale of our 20th anniversary week. Chip, I know you started off the week with a video talking about the history of the of stock charts and many of the obstacles that you've kind of worked through over the last 20 years. I know it was probably close to 20 years ago when John Murphy came on board here at StockCharts. So kind of first, I want to welcome both of you back to the show. And I don't know, maybe talk a little bit about how John came on board.
Oh, hey, sure. No problem. Again, 20 years, it doesn't seem like it. It seems like only yesterday. But I do remember many years ago that John was making a presentation here in Seattle, and I'm sure he was a little confused because after his presentation, this crazy kid came up to him with a bunch of demos of a website that he was making called StockCharts.com, and would John and his partners be interested in helping with that? And fortunately for me, John's gave me the time of day and said yes. And we've gone on since then. Hopefully, John, you've enjoyed the trip as much as I have since then.
I have. It's hard to believe it's 20 years, Chip. We were obviously very young when all this started.
And much better looking, obviously.
Just to add to what you said, we had a little website, Murphy Morris, where we were providing content, and you had but we didn't have charts. You had the charts and didn't have the content. So after bumping heads for a couple of years, we said, why don't we just merge the whole thing and we'll provide some content, you'll provide some charts. And that's really how I got involved. And it's been a nice ride.
Yes, highlight of my career absolutely is working with John Murphy. And it's been a pleasure. Let's keep going. Let's do another 20 years. What do you say?
I'll give it a shot.
Me too. But are we doing John's stuff now? All right. So John, let's talk about your most recent market message, and I'll just give you the floor.
Well, I wrote this yesterday, Chip, and the reason I thought that we've all been talking about, we hear this every day, how yes, the U.S. stock market is strong. Obviously, the U.S. economy is strong. The real concern is foreign markets. We keep hearing how the global economy is really slowing, like in Europe, China especially. And that creates a danger for us, because you don't like to have. It's not good when you have the strongest economy in the world and everything else is weakening. So I thought it might be a good idea to focus on that this week. Now, bear in mind that moves in stocks generally lead turns in the economy. So we're going to be looking at foreign stocks here mostly, but also drawing some implications about the economy. And there is some good news here. If you go back over the last year, the biggest problem, the biggest concern of most of us was that the U.S. stock market was going up and stocks everywhere else in the world was going down. That has taken a turn for the better. In fact, if we go to that first chart there, you can see that I'll just describe it very simply. This is the all-country world index ex-USA. So this is what's happening outside of the USA. And I'm just going back about a year. This, by the way, includes foreign developed and emerging markets. So it's a nice proxy for what's going on in the rest of the world. And just going back, this index peaked last February. And while our market was hitting new highs, I can recall, for example, last September, the end of September, the beginning of October, our market was hitting new highs. So the S&P was trading at a record high. And this index, right at the beginning of October there, if you can see that, this index was actually hitting a new low. That is highly unusual. You know what I mean? That kind of a discrepancy, it just couldn't last. And I think that was kind of a precursor that led to, or at least contributed to, the big sell-off that we had in our market, the fourth quarter, where we fell very close to 20%. So that's the bad news. The good news is if you look at the chart now, since December, this thing has been moving up, and just applying some simple technical tools to this, you can see that the ACWX broke its major downtrend line. So the downtrend is over. We've crossed above our the red 200-day moving average there. That very obvious stuff. That's the red circle. And also just one other little thing. You notice the blue line there, which is the 50-day moving average, has crossed above its 200-day. So I think it's good news for the U.S. market, obviously, when the other markets are rising to support. It's a matter of global breadth. In other words, more markets are rising now than are falling. And also to the extent that, as I mentioned before, that stocks do tend to lead turns in the economy, although the economic numbers aren't all that strong overseas. The fact that foreign stocks are doing so well now and appear to be in new uptrends, I think suggests to me at least that the concerns about the weakness in the foreign stock markets may be overdone, and we may start getting better news as the year goes on. So that's a good sign for the global economy. And one other thing I want to mention is that I mentioned this includes developed and emerging markets, both of which have done very well. Our market, by the way, is up about 15% in the first quarter. Foreign developed and emerging markets are just a shade below that. But one market that really stands out, and I think this will fit into maybe some of the things that Tom and Mary Ellen already mentioned, and that is China. China, over the last year, since the first 4 months of the year, has been the strongest market in the world. And I think that's a very, very good sign. So we can just move on to the next chart. There you go. Shanghai. Well, we can look at the paragraph first of all. If you just back down just a little bit, Shanghai stocks are rising faster than the U.S. That's a total reversal of roles. Last year, China was, I think it was the weakest stock market in the world, and that carries all kinds of negative implications. But if you look at chart 2 there are 2 lines on the chart. The red line is simply a chart of the Shanghai index through yesterday afternoon. I believe it's closed today in China. But you can see that it's trading at the highest level since last spring. By the way, it's up 30% since the beginning of the year. That's really extraordinary. And as far as I can see, that's the strongest market in the world. Now, the green line there, you get into a little ratio analysis. That is a ratio, a relative strength ratio of the Shanghai index divided by the S&P 500 index. So it shows us what China is doing relative to the U.S. And you can see that green line fell all throughout last year, which obviously meant that the Chinese market was really dramatically underperforming the U.S. market and had everyone concerned. It is the second biggest economy in the world. But you can see that the ratio actually bottomed in October. Part of that probably had to do with the fact that we fell a little bit harder during the first quarter, during the fourth quarter. But you can see that it bottomed in October, and since the beginning, let's say the end of January, you can see a very dramatic move to the upside. So as I mentioned, the Shanghai index is up 30% since the beginning of the year. The S&P 500, representing the U.S. market, is up 15%. Which means that China has doubled our performance. I mean, that's a very dramatic role reversal. And bear in mind that China is the biggest country in the emerging markets universe, the EEM, emerging market iShares. China accounts for like 30% of that. So I think the fact that China is rallying so strongly, it's giving a big boost to emerging markets. It's giving a big boost to other markets. So I think that's a very good sign. And again, there's been concern about weakness in the Chinese economy. The central bank there is easing. There are more optimistic soundings about the possibility of a trade deal, maybe sometime over the next month or two. All of this is feeding into the Chinese market. It's rallying, and I think it's a good sign. And again, it's the world's second biggest economy. So I think the fact that it's showing leadership is a very, very good sign for emerging markets in general. But there are other implications to this, and other speakers have already alluded to this. For one thing, Chip, if you just move down a little bit. Oh, there you go. You can stop there. Asia has become, outside of Japan, we're not talking about Japan so much, although that's sort of lagging a little bit behind. I'm talking about Asia, Taiwan, and South Korea. 2 other emerging markets are very closely tied to China. And you can see that, again, the rally in China is giving a huge boost to that area. This chart here, chart 3, is a chart of the Taiwanese ETF. And you can see that also bottomed at the end of December. And that has also rallied quite nicely. it's risen above its 200-day moving average. So the Taiwanese stock market is doing quite well. I don't have a chart here of South Korea, but that is also doing quite well. So the rally in China is also giving a big boost to other Asian markets that trade a lot with China. But it's not just the Asian markets. There's also Australia. We can move down just a little bit. This is I tend to always show the ETFs. So it's easier to do that. This is the EWA, which is the Australia ETF. And you can see, in fact, I could have overlaid the Chinese market on all of these and they'd all look the same. You can see the Australian market also bottomed at the end of December. It was down most of last year and has rallied quite strongly. It's above its 200-day. You can see the blue line, which is the 50-day moving average, the golden cross moving above that. So, and Australia, bear in mind, the reason I'm mentioning Australia is that Australia, because of its position in the Pacific Rim, does an enormous, in fact, I believe China is its biggest trading partner. In fact, it is. China is its biggest trading partner. So when China does well, Australia does well. And one other thing about China going up that I forgot to mention, the Chinese yuan, the Chinese currency, has also been quite strong this year against the US dollar. So that makes it, aside from the fact that the Chinese market's looking strong, and the fact that the Chinese yuan is going up, makes it a little easier for the Chinese to do more importing of foreign goods. And of course, Australia is one of the main beneficiaries. In fact, over the last week, some of the commodity markets have started, not just this last week, over the last quarter. Australia is a big exporter of natural resources, and two of the commodities in particular that have really started moving up that Australia does a lot of exporting of is copper and iron ore. I don't have a chart of copper here, but if you look at the chart of copper, you can see that it's moved up close to 20%, not quite 20%, but close to it. But it certainly looks like the price of copper has bottomed. And iron ore, I don't have a chart of iron ore, but iron ore has also been quite strong lately. And those are two big exports of Australia, and most of that selling goes to China. So that's a very good sign. And also, Mary Ellen mentioned materials, for example, were the strongest sector this week. That has to do with chemicals and some other things, but also copper stocks and steel stocks, industrial metal stocks are also among the leaders over the last week. So there are a lot of implications. Strong China market feeds into Australia, feeds into stronger commodity markets and mining stocks in general. Copper mining stocks, steel mining stocks, and even some of the foreign stocks like Billiton and Rio Tinto are doing extremely well. They're very much involved with copper and iron ore. So there are a lot of good things happening to a lot of different markets, which are feeding off this new rally in China. And then one other thing that I think one of the other speakers has already mentioned is in our market, semiconductor stocks. You just move down just a little bit, Chip. There we go. This is 5. This is simply the PhilX, Philadelphia Exchange Semiconductor iShares, SOXX. Again, if I overlaid the chart of China on this, you wouldn't be able to tell them apart. But you can see that after having a down year last year, semiconductor stocks bottomed in December with China. And actually, this is an amazing run. They went from being in a bear market, or very close to a bear market. This particular ETF has hit a record high, and that's an amazing run. And the reason I point that out, aside from the fact that semiconductors are helping lead the technology sector higher, this particular group has tremendous exposure to China for all kinds of reasons. So when the Chinese market is weak, that's not good for semiconductors. It has to do with supply chains and all kinds of other things. When the Chinese market is strong, semiconductor stocks start to be strong as well. So rally in semiconductors, rally in materials, I think all of these things, I'm not saying it's the total reason, but I think they have a lot to do with this rebound in China, which is feeding into a lot of other markets. And then one final chart that I just want to look at to move away from Asia, to show that this rally is broadening out. We keep hearing every day, or I keep hearing that the European economy is quite weak. I'm not even going to talk about Britain and Brexit. I'm talking about the Eurozone. They're quite weak. Italy is in recession. Germany is very close to recession. They're calling for another flat quarter, and the news just seems to be bad. But if you look at the charts of the stocks, we are seeing signs of improvement. This is the MSCI Eurozone ETF, EZU, and you can see that we're getting the same pattern. This group also peaked at the beginning of last year. It fell sharply. Notice the collapse during the fourth quarter, which had a very negative impact on our market. But there again, this group has bottomed in December. If you look at that circle there, this was through yesterday, obviously. They're a little higher today. We have broken above the 200-day moving average. We've broken that downtrend line. So I think that's good news. And also, I don't want to overplay the China thing, but bear in mind that countries like Germany, which is really the largest stock market and the largest economy in Europe, they've been caught in the crosshairs between the dispute between us and China, because they do a tremendous amount of trading. Germany in particular is an export-oriented economy, and a lot of their exports go to China. So they've been kind of caught in the crosshairs of this whole thing. So here again, I don't want to overplay the China thing, but I do think that signs of strength in China, and the fact that the Chinese yuan is stronger, and China may be able to do more may want to start doing more buying. I think that may also feed over into the Eurozone. And as you can see, this has been one of the weaker parts of the world. But if you just look at the chart, it seems to be turning higher. And again, if you subscribe to the premise, which I always have, is that stock prices usually act as leading indicators for the economy. This chart and the other charts that we've also shown suggest that the global economy may, in fact, have already bottomed. Now, normally, it takes a little longer for these numbers to filter through, but it does suggest that the global economy is starting to strengthen in Europe and in Asia, and I think that's a good sign for everybody. So I think there's a lot of good news in these charts. So again, just to come back to where we started, I think this has been one of the biggest concerns that we've all had about a weakening global economy. And as I said, the charts suggest to me that the markets are bottomed, and I think that's good news. Now there is one potential negative in this whole thing, and that is that over the last year, with weakness in foreign markets, the U.S. market was really the only place to be. I mean, if you look at charts. However, and that's where most of the global money has been placed. However, now with the European market starting to turn up and emerging markets starting to turn up, and foreign markets doing almost as well as the U.S. and some of them even doing better, I think there's a chance that we may see some global rotating. Tom's talked about rotating between the market sectors, but as you know, there's also rotating around the world. And I suspect, I've been hearing, I listen to TV and I read the papers, and I keep hearing that U.S. stocks are now even though they look great and all that, they are getting up against their old highs. And I think, given the extent of the run that we've had so far this quarter, we're only 1% or 2% away from the old highs. Valuations are beginning to look a little rich again, and I think some traders may start to turn a little more cautious on the U.S. market. But at the same time, these foreign markets, and I know I keep hearing people talk about emerging markets, but I would put the developed markets in that as well. They look a lot cheaper than the U.S., and they are just beginning to turn up. So I think that there is a risk. I wouldn't even say a risk. I think there's a very good chance that money managers this year may start taking some money out of the U.S. market, which is viewed as relatively expensive, and start moving some of that money into foreign markets. And I know a lot of advisors I talk to are really focusing in on emerging markets, but I think foreign markets in general. So that may be a slight negative. So a slight negative in the sense that some money may start to rotate. But taking it from a broader scheme, I think that the fears of a global slowdown are somewhat, I won't say they were overblown, but I think that the crisis or the real concern has passed. And I think that there's good news here as we move further into this year.
Okay, thanks, John. I know Tom has some questions queued up for you, but also I just wanted to ask about the bond market and kind of where that's currently at and how that's reacting to all of these changes.
Yes, this is very strange. Normally at this point in the cycle, bond yields should be moving higher, and a lot of people have pointed out this discrepancy. The fact that over the first quarter, when stocks have been so strong, bonds have also been strong. And this is highly unusual. There's been a lot of concern about the yield curve inversion that's taken place over the last week or two. I suspect, however, that a lot of the weakness, just like stocks, global bonds are also very highly correlated. I think I wrote an article on this a week or two ago, that if you take the German Bund, for example, the yield on that is very closely correlated to yields here in the U.S. And if you overlay the two, you can clearly see that the biggest drop has come in German Bunds because of the weakness in Europe. In fact, that yield has turned negative. And that has a tendency to pull our yield down because U.S. Treasuries pay a little bit higher yield. So I think you could make the case that the weakness in the U.S. bond market yields maybe isn't telling us so much about the American economy as much as it's telling us about weakness in foreign markets. And I think that has really been a drag. So I'm a little bit suspicious about this yield curve inversion, because in the past, whenever we've had a yield curve inversion, that's always been caused by usually in a late cycle move. We get a big burst of inflation. The price of crude oil goes through the roof. The Fed raises interest rates to combat inflation, and that causes an inversion of the yield curve. This time, we're not getting that. The inversion we're getting this time is more the result of long-term bond yields dropping. So I'm a little suspicious about the inverted yield curve and what the message is giving us. And I do think, just to come back to the global thing, if I'm right here and the global economy is starting to strengthen again, and European yields and maybe Japanese yields start moving higher again, I think that may eventually put upward pressure on bond yields here in the States. But it may be telling us more about foreign markets than it is about the U.S. market.
Hey, John, can I follow up? I want to follow up on your comments about the German 10-year Treasury yield and U.S. and the correlation, if I can. I'm going to go ahead and share my screen. So let me grab this screen and show everyone what I'm talking about here. This is a chart of the 10-year Treasury yield here in the U.S. minus the 10-year Treasury yield in Germany. And you can see since 2011, the yield has been rising on a relative basis in the U.S. much faster than Germany. And I think that's what you were alluding to, yes. John.
Yes. And
also at the same time, while our Treasury yields have been rising so much faster, it's also put a lot of upward pressure on the U.S. dollar. Correct. And so I was going to follow up. I had a question already picked out here for you as well, that with the dollar rising, I know some of these ETFs that we talked about earlier are negatively impacted by a rising dollar. So are there other vehicles, like if you wanted to invest, for instance, in Germany, we could do so through the EWG, but as long as the dollar continues rising, that kind of eats into those returns. So do you have any comments about the dollar and how you might consider investing in some of these foreign markets?
Well, for one thing, Tom, in Europe, they do have ETFs that are currency hedged.
Okay.
You're right. For example, when the euro is down, like all the ETFs that I showed you from Europe, the EZU, when the euro is down, that kind of weakens the performance a little bit, right? For an American investor, right? When the euro is dropping, as it is now, for example, that will detract from your profit if European stocks go up. But the one way to get around, I forget the exact symbol, but there are a couple of ETFs in Europe. In fact, there's the EZU that I showed you. There's an unhedged version of that, or hedged version, I should say, that factors out that currency move, so that it should actually do, if the euro continues to weaken and the dollar continues to strengthen, a currency hedged ETF should help alleviate that problem.
Okay, cool. Do you think it's a good idea to continue to watch the relationship between the U.S. Treasury yield and Germany's for clues as to the direction of the U.S. dollar?
I think so. As you can see, it certainly has held up, and the fact that the Treasury yields are stronger than the. Although one thing that is a little interesting, Tom, that has puzzled me a little bit. If you go back over the last month or two, this may seem hard to believe, but Treasury yields have fallen actually a little faster than German yields. In fact, you can see it right at the top there, which is a little surprising, and I'm not quite sure what to make of that. But generally speaking, if the premium between Treasury yields and German yields hold up, that should be a positive sign for the dollar.
Okay, another question for you. When we really got into the heat of battle with the U.S.-China trade war last year, no doubt the U.S. was outperforming many parts of the world. And I always looked at that and concluded that the market, the international markets, believed that the U.S. was going to get the better end of the deal. That was just kind of the way I was viewing it. But now, as we seem to be getting closer and closer to a deal, China, as you pointed out, has had a huge move to the upside. Do you think that's just a temporary move back to the upside, or do you think that China is going to be a winner in this? I mean, they're going to be a winner in the trade deal because they don't want all the tariffs and everything. But do you think that they are a bigger winner than the U.S. in this deal, or is it the other way around?
Well, everyone's going to win, I think, if we do get this. I think what we're seeing, Tom, is that what it's telling us, and I think there's a lot of truth to this, China needs us a lot more than we need China, because we buy the stuff from them. They don't buy a lot of stuff from us. So if we stop buying Chinese goods, that's not good for them. So I think the fact that China did so badly last year, I think it was the weakest market in the world, grossly underperformed the U.S., simply told us that they had a lot more to lose in this. Not so much that it was a bad deal, they just had more to lose. Mm-hmm. And now I think the fact that the Chinese market is coming back, I don't think it's that they're going to get a better deal than us. It just means that they, like I said, they need us more than we need them. And I think that that's just being reflected in a stronger market. So it's not so much, I don't think it's a matter of them getting a better deal, but a good deal. And I think it'll benefit both countries. And I don't think this Chinese outperformance will continue, indefinitely, but at least that's the case right now.
Okay, a couple questions in the room. One was, what's your favorite analysis method indicator for evaluating purchasing decisions? So I'm going to paraphrase a little bit and just say, what's the one thing that makes you feel really good about U.S. stocks, for example? Is it, jobs continuing to come in ahead of expectations? Is it low inflation? What exactly does John Murphy look at when you decide, okay, this is a good time to be in U.S. equities? What is it your go-to?
Well, low inflation is a big part of it, and the Federal Reserve. I think what's really turned this thing around was the Federal Reserve turning quite. You remember what happened back in December when the Fed said things were on automatic. The market really plunged. The Fed turned around and turned a lot more dovish, and I think it was January, and that really turned everything around. And also central bankers in Europe turned a lot more cautious. Australia, Canada, they've all turned a lot more cautious. So I think that has extended the life of this 10-year bull market and the economic recovery. So I think the Fed has a lot to do with it. And also inflation, as I mentioned, every cycle that I have studied, going back to the post-World War II era, every economic cycle, every upside move, economic expansion has been ended by a burst of inflation, which has caused the Fed to raise interest rates, which has led to a recession. This time around, there's almost no inflation. Mm-hmm. So there's no real incentive for the Fed or the European central bankers to raise interest rates at this point. In fact, there's some calls for them to lower, which I don't really understand at this point. I think if the Fed just sits back for a while and inflation stays low, that it could extend the life of this expansion. Bear in mind, we've just crossed the 10-year threshold. This is the longest bull market in history. And if we get to July, which it looks like we will, this will be the longest economic expansion in history. People talk about this being late cycle, but late cycle is normally characterized by a big burst of inflation And so far, we're just not seeing that. So I think it could expand, or extend this almost record-long global economic expansion.
All right, one final question from the room, and this relates a little bit back to the dollar. A question came in and said, do you think that strength, this renewed strength that we're seeing now in overseas markets, will that result in a lower dollar going forward?
That's a very good observation, Tom. Because if you're an American investor, for example, and you want to buy stocks in Europe, you have to buy the currency. Mm-hmm. You have to buy the euro. If you want to buy stocks in China, you have to buy the currency. So if it's true that this relative ratio continues, and I think it probably will, that foreign stocks will continue to do better, I think that's going to contribute to some buying in foreign currencies, and I think that may also it's just the opposite of what I just said 5 minutes ago. But that may actually make it much more difficult for the dollar to rise from here. So just like foreign stocks look like good bargains at this point, foreign currencies might be pretty good bargains also.
Awesome. Well, I'll tell you what, it was a great presentation, John. I'm really excited that you were able to join us this week. It's a special week here at StockCharts, and we certainly wouldn't want to have this week without you. That's for sure.
Well, thanks for inviting me, Tom, and I hope you'll invite me back.
Yeah, you're coming back in on Monday.
Okay.
If I have anything to do with it, you'll be back on Monday. Always.
Yes. Thanks, John. Great. Really did appreciate it.
Yeah.
Okay, Chip.
All right, Chip. I know you've got some announcements. You came on beginning of the week and kind of recapped everything over the last 20 years. What do we see going forward?
Well, we have a couple of big announcements that I want to make. Let me get my presentation going here, and then we will get into it. So most of this past week has been focused on kind of the history of StockCharts. 20th anniversary seemed to be something that we wanted to commemorate. But I am always focused on the future. I think the past is great, but it's always just like with the stock market. What are you doing for me lately? And what are you going to do for me in the future? And we understand that. We're focused on that here at StockCharts. And I want to basically report to our members, as it were, our users, the people that care about our charting tools, what we're up to, what we've been doing, and how it benefits them, and what we're going to do in the future, which I think will really benefit them. So when I think about the future, the first thing is I do want to mention that we have consistency in what we're doing. We have a mission. We've been following that mission from day one. You've heard me say it probably in the video interviews earlier this week. It's the same thing. We want to help online investors make better investing decisions by providing high quality financial charts, analysis tools, commentary, and education. We think combining all those things together into a unified package, especially the education component of it, really, really helps people benefit from all the tools and data visualization that we provide. So we're going to continue to focus on that very carefully. Underneath the covers for the past year, I've mentioned this a couple of times, but I haven't mentioned it recently, and I wanted to make sure everyone was aware of this. There has been a huge kind of ground shift underneath your feet. We've tried very hard to make this shift invisible to people, but I cannot stress to you the changes in technology that have happened over the past year and that are continuing to happen. Essentially, when we started 20 years ago, there was no such thing as the cloud, and we had to have our own data center. In fact, I'm looking at it right now. It's across the room as I sit here in StockCharts Studios. That data center, we've been maintaining it for 20 years. We've done a reasonably good job with it, but it's no fun maintaining a data center. If the power dies, if other kinds of problems happen, then we're on the hook to get all that fixed. And I think we've done a reasonable job for that, but there have been a couple of hiccups over the past 20 years, as you might imagine. We are now moving to the cloud, and we've been moving to the cloud for the past year. At this point, I can report to you that over 75% of the servers in our original data center are now turned off. We are providing most of the charting capabilities at StockCharts from the cloud. And in fact, 100% of our Sharp Charts charting tool, all of that comes from the cloud now. And there's some significant advantages to that, although those advantages are not necessarily obvious to someone just using our site. If you're used to using our site, you're used to it performing well and providing you with great accurate charts. And that continues to be the case. However, behind the scenes, our charts are now more reliable. They're faster. We can make them, we can react to demand much, much quicker, so on and so forth. So let me go over these 4 key improvements that moving our charts to the cloud have provided. The first is high availability. So we're using the Amazon cloud, AWS, and the Amazon data centers are frankly way better than the data center that we have here. The one we have here is fine, it's good, but it's ours and it's in an office building, and it has some weaknesses. So by moving into an Amazon data center, we become much more reliable automatically. And in fact, in January, when we moved Sharp Charts in there, we were more reliable right out of the get-go. They have better power, backup, heating, cooling, all that other stuff they have, and we take advantage of. And then really cool, last week, there's a little techie, I know, but it's really cool. Last week, with a press of a button, we actually then split our Sharp Charts tool, so it now runs in 2 different Amazon data centers, meaning that if there ever is a problem in the first one, the second one's going to automatically take over and handle things. So while there have been and there may still be a couple of growing pains and hurdles for us to fully overcome, we are fundamentally in a better position technically than we've ever been in terms of providing reliability and availability, high availability to our users. And that's a good thing. Related to that is the concept of scalability, the ability for us to react if there's a large change in demand for our charts. So what I have up here on the is a graph of the charting engines, the charting servers that we use. And this graph is from this morning. The times are in Pacific time zone. And what it shows is down at the bottom, this was before the market opened. We only had a couple of servers that were running and serving charts because we only needed a couple of servers to run and serve charts. Right here, before the market opened at 6:30 Pacific time, we got ready. So we scaled up by adding a whole bunch of servers. We probably added 15 servers at this point. That's what all this jumble is. When we did that, and before the market opened, our ability to serve charts became very, very quick. We do that a little early just to make sure that we have all of our charts servers ready to go. It's right at 6:30. And you can see at 6:30, then the demand for our charts increased, and it got up into our target zone. Between these 2 lines, this is our target zone. We did some things here. Don't worry about these lines. These are allowing us to use other kinds of servers that don't cost so much. We do that after the market is fully open, and we do it behind the scenes so that nobody notices. And then we continue on. The important thing is if there was a traffic spike and these lines started moving significantly above the top dotted line, we'd simply add more charting servers. We would get more charting servers from Amazon. We'd immediately add them just like we did down here, and we'd be able to handle that load. And then later when the market closes, we start giving these servers back to Amazon. And again, then we're back here during the evening, during the early morning hours. We don't need as many servers, and so we don't have them. That's really, really good. You can also see over here, just as a quick little note, this column labeled AZ. These are the 2 different data centers I mentioned. Half of our charting engines are in A, and the other half are in B, and they're ready to take over if one of them fails. And the result of all this is actually, since we moved into Amazon, we've been sending out a record number of charts. And every day, more and more charts, more than we've ever sent out before, are going out to our customers. The data center, again, that we had here on premises was great, but it was limited in the number of servers that it had. That number could never get bigger or get smaller. It was always the same. Now we're able to scale dynamically. Very good. Data security. So by data security, I'm specifically talking about backups and our ability to retain your information, keep it safe, keep it protected. And if for some reason there's a problem, the ability to restore that data. Up in the cloud, there's a ton of disk space. Down here in our data center, not so much. And that's actually been a problem in the past in terms of the number of, or the amount and the duration of backups that we have retained. In the cloud, backing up data, the space there is essentially unlimited. And so we're going to be able to back up data and restore data much more effectively in the cloud. And in addition, the database itself that we're using, the databases we use here have been very, very good, but that sometimes they get, for lack of a better word, cranky. Sometimes it's a little frustrating to manage them. The data servers in the cloud, it's just one data server, and it can grow and scale as much as it needs to. It's much, much easier to manage data when you're using a cloud-based database. All right, so those are just standard things. You expect that from StockCharts. We've been delivering it for 20 years, and all I'm saying now is we can deliver it even more effectively. That's the bottom line there. But the future is really where things are at. What are we going to now be able to do? Well, our data center here in StockCharts is also essentially at capacity. So adding additional capability, adding a lot more features that would require a lot more servers, that was really not in the cards using the data center here. In the cloud, we can do anything we want. And so the real benefits of this change, as I say on this slide, come from what cloud computing enables. Some of those improvements are already here, and I just talked about them. Some I'm going to announce today, and then a ton more are coming in the future. And I think the next 20 years may be even better and show more growth capacity, and more potential for amazing things from StockCharts than the previous 20 years. And that's a bold statement, but that's my hope. And the cloud is going to enable that. So what are some immediate benefits of the cloud that you're seeing? Well, immediately, we are announcing today that our Chart Watchers newsletter is going from a bi-weekly publication to a weekly publication. That's not necessarily a huge cloud benefit, but it's a big deal in terms of you'll be hearing from more of our commentators on a weekly basis through our Chart Watchers newsletter. And if you're not subscribed to that, I strongly encourage you to subscribe. That's also where we're going to continue to make announcements about additional new features that we provide to the site. On all of our blog articles, we've now just added, as of yesterday, something called text-to-speech, if I could speak, versions of all of our commentary. We're adding that to our blog articles. We're adding it to our educational articles in Chart School. And so you will start to see at the top of everybody's blog a little button, and you can just click that button if you want to listen to the blog being read to you. That's provided by a service that Amazon has called Poly. And we think it's a convenience. It's not super wonderful. Some people still want to just print it out and read, and you can do that. But if you just want to listen to the latest blog article from Greg Schnell or whoever, you can do that and just click the button and you'll hear it. Yesterday, we moved our scan engine up into the cloud. I mentioned that our charting engines were up there. Our goal is to move everything. And yesterday, we moved our scanning engines up there. So not only are the scanning engines now in a much better data center with all the benefits I mentioned before, but they also run faster, and they load data faster, and they're able to do their scans faster. And so just by moving them up there, we've got immediate benefits to getting to much faster updates to the scan data. And so you're getting near real-time results when you run your scans for the people that really care about minute-by-minute data. And then the final thing that I want to mention right now is we have partnered, when we moved to the cloud, we also partnered with a new data provider. And this new data provider is very exciting. They are cloud-based. They are cloud-oriented, meaning that they are giving us much better and faster access to data in the cloud than any other data vendor that we could have gone with. The name of the company is Xignite. We think they do a great job. We're still in the process of transitioning all of our data over to Xignite. Once that process is complete, however, we will be 100% cloud-oriented, both in terms of where we get our data and in terms of how we display the data. So really looking forward to that. There's several other things that Xignite provides that we should be able to take advantage of down the road. Okay, so that's what's available right now. What's coming? Well, we've got a lot of things in the pipeline. We are working very hard on an official StockCharts app. It'll run on both iPhone and Android. You'll be able to see your chart list. You'll be able to swipe back and forth to move through those chart lists. You'll be able to manage your chart list very quickly and easily. It's going to make it's essentially a companion for the use of the website. You create your charts on the website, you make them look really great, and then you can take them with you on your phone no matter where you are and be able to see them very easily and quickly. We've always had a web version of our website. This is an actual app, and it will have a lot more user interface that people who use the phone are used to seeing. An even bigger initiative that's underway. I don't have anything official to announce about this. This will be happening over the course of the next year. It's already, a lot of groundwork has been laid. We'll have official announcements later, is StockCharts University. If those of you have been paying attention, there's lots of online university classes available these days from real universities as well as other kinds of organizations. We're going to leverage all of that. We're going to provide online learning experience that's really customizable and very, very tailored to technical analysis, learning charts. Very, very excited about that. Look for something about that soon. Another thing super interesting and fascinating, I think, and hopefully a big hit down the road, is what we call our gamification initiative. In other words, we want to take the charting capability that we have and allow people to use it for things other than necessarily the stock market. So for instance, fantasy trading. Fantasy paper, it's like paper trading on steroids. It's like fantasy football, only with stocks. And we're actually very far along on our progress with the fantasy trading game. I'm not officially announcing it yet, but I hope to officially announce it within the next couple of months as we continue to work out some of the details on it. I think that'll be super exciting once that's available. Obviously, StockCharts TV is a cloud-oriented technology that we continue to use. We have been, and we will continue to put more and more and more video content, educational content from StockCharts TV up into the cloud. So much, much more from all the capabilities of the cloud. But there is one more thing. Everybody see Steve Jobs do his presentations at Apple? He would always end up with, oh, and there's one more thing. Here's the iPhone, something big. So I'm trying to do that. And this one more thing we're super excited about. It's called StockCharts ACP. ACP stands for Advanced Charting Platform. We're announcing it today, and we will be delivering it today. It is simply the web's most powerful interactive charts. I think you're going to be super excited about this. So let me start with a quick demo. StockCharts has always been about high quality charts, but most of our high quality charts have been generated on the server. The charts have not been super interactive. We provide things like chart notes and the annotation tools and so on and so forth. But to make the charts super interactive, we needed the browsers to get better. And the browsers have gotten better. If you haven't noticed over the past couple of years, browsers are much more capable now. And so you've seen this at other websites. We know other websites exist that do similar stuff. But we've been working hard behind the scenes to take all of our knowledge of charts, our capability that we now have in the cloud, and bring that together into a truly amazing and interactive charting experience. So this is a very, very preliminary version of the full edition of StockCharts ACP. In just a minute, I'm going to show you how you can use what we're releasing today, which is what we're calling a technology preview edition of StockCharts ACP. But it has all of the interactivity that you would expect, all of the streaming. You can zoom in, you can zoom out, you can add annotations. There are tons and tons and tons of different indicators that you can add, much more than what we currently have, frankly. You can change the look and the feel of things. I always like the mountain view, back and forth. We can add some really cool interactivity as you can add a second charting line and then move that back and forth. Am I hearing oohs and ahs out there on the internet? Hopefully, maybe a couple of oohs and ahs. Our focus here, just to be clear, is on the interactivity of this chart. We already have a really great charting package, Sharp Charts for static charts that you want to review in a more static way. That's what people have been doing with StockCharts for 20 years. This is for the people that want to reach in and touch the charts, drag the charts, look at comparisons, make comparisons, that kind of thing. And so we have the ability to see lists of ticker symbols and how those symbols are doing. We're going to be able to connect these lists up with your chart lists, scan results. All of the different things that you're used to providing will be available to you here as part of the ACP platform. And then I also want to say the ACP platform, Advanced Charting Platform, the platform portion of that means that we are partnering with other companies. we're partnering with other individuals and companies to provide us with even additional indicators, capabilities, adding to this charting platform that will just continue to grow and expand what's available. So there was one other thing I wanted to show you real quick, is that ACP is also about multi-chart. So here's a quick example of multi-chart, and we're working really hard to make it very easy to shift and move charts around and keep a lot of different charts open on your screen very quickly, very easily switching between them. You notice I'm using the full screen of my display, and that would be true if my display was super huge or if I had 2 displays, 3 displays, so on and so forth. So all of that capability is there. We're working really hard on making it very, very easy to use. But if I go back to my demo or to my presentation now, I do need to make a couple of things clear. Again, ACP is everything that we know about charting, everything that we've learned from you, our users, over the years about charting, about what's important, combined with the cloud to give a great interactive charting experience that's available anywhere. So that's the mission statement there. And as I mentioned, our Technology Preview Edition is available for free right now. I'm going to give you the URL in just a minute, but I don't want to give it to you this second because I want to do a demo. And if I give it to you right now, you're not going to pay attention to the demo and things might bog a little bit. So the ACP Technical Preview is what's available to now. It doesn't have everything that I just showed you. It has a lot of what I just showed you, but not everything. And part of that is because we're still working on all the details for the advanced version of StockCharts ACP. But we have enough in place that I really wanted to get this out to everybody, especially as part of our 20th anniversary. And so this is what that looks like. You have a limited number of symbols that you can use, and that's just so that we can make sure that we're delivering on the back end the data appropriately. You have a limited number of periods that are available, daily, weekly, and we do provide 5-minute as well. You have a limited number, but still cool, of charting types, and so on and so forth. These are the different indicators that are available, color schemes, and you do have the ability to have up to 4 charts on your screen at the same time. By the way, if you don't like the numbers that appear when you mouse over, you can click on the little target here, and then you shouldn't see them. I guess you don't see them right in the chart that's selected. There we go. There we go. So I think you'll be able to just play with this and figure this out. We don't have documentation really for this. We don't have support for this. That's why it's a technology preview. We're working really hard on putting those finishing touches on the real deal, and we'll have that real deal available for you later this year. I'm going to give you a timeline in just a second. But I still think, and I still wanted to get out to everybody all the different things or all the things that we do have ready, and so you can begin to play with it and see what we're doing. So hopefully that'll be useful for you. It is all free and it's all available for you right now. Here's the URL. It's down at the bottom of this slide, stockcharts.com/ACP-demo. And I know that right now all of y'all are hitting that URL immediately at the same exact time. I think it'll go well. We've scaled out our charting, our cloud systems artificially to make sure it goes well for you. That's available now. The full version will start to beta test in June. Look for announcements in ChartWatcher's newsletter. And then we hope to have the full version released by August, if not sooner. We've made a ton of progress, and we will continue to make progress until that's available and out for everybody to use. So some quick FAQs. I'm going long, but it's important. I want to make sure people are understand. StockCharts ACP is in addition to SharpCharts. We're not changing anything about our existing charting platform. It's still there. It still works exactly like it's always worked. ACP will not replace it. ACP complements SharpCharts, and SharpCharts complements ACP. A chart that you create in one won't necessarily be available perfectly in the other one, but we will allow you to at least move ticker symbols and the basic configuration of charts between the two platforms. But not everything will move. There are some features that will only be SharpCharts features, and there's some features that will only be ACP features. That's fine. You'll use whichever tool is the most appropriate for you each time. Again, how much does ACP cost? It is free. It is free in the sense that SharpCharts is free. We have a free version of SharpCharts. if you're a member, you get additional capability and you get additional access to data. So you get access to intraday data, you get access to real-time data, you get access to longer amounts of data, so on and so forth. That's what a StockCharts membership provides. And ACP works exactly the same way. There'll be a free version, but if you're a member, you will be able to do more and you'll be able to save your work. What data does StockCharts ACP use? We worked really hard on this. It uses the exact same data that SharpCharts uses. It uses our data. It doesn't use anybody else's data. So that includes data that has been adjusted and maintained for technical analysis purposes. That's always been our goal, and we have that data. We provide it to SharpCharts, and you'll see the exact same data in StockCharts ACP. And so how does StockCharts ACP stack up to the competition? Well, we think it stacks up really, really well. We think our focus on interactivity and our focus on knowing what users really need from a charting platform is going to make ACP the most powerful interactive charting platform on the web. And then you probably have a question, at least one or two in your mind right now. Will I be able to do X? Will I be able to do Y? The answer is hopefully. The answer is we can't answer that question right now. Wait until the full version's available in beta. We'll have our support staff up and ready to go, answering your questions. We'll be able to take a lot of suggestions for improvements and so on and so forth at that time. At this point with the technology preview, it is what it is. And hopefully you'll get a sense of things by using it. But just hold those questions. You're going to be amazed by everything that the full version can do, even above and beyond what the technology preview can do. And at that point, then you'll be able to get the answer to, will I be able to? I hope, and I expect the answer will be yes. And so again, thank you for listening. StockCharts ACP will be simply the web's most powerful interactive charts. There's the link one more time. I hope you enjoy it.
Hey, Chip. First of all, this has been a tremendous week. You started it off going through a lot of the stuff that we've been through the last 20 years, and I think you're wrapping up the week here going through a lot of exciting stuff at StockCharts as we move forward. There were a couple of questions in the room. One is just very general question. How many people use StockCharts.com?
We do not know the answer to that. We do track members, but a long time ago, I stopped tracking the free users of the site because basically it put me into analysis paralysis, if you know what I mean. There's so many different metrics and other kinds of things you can do. We watch our servers. We make sure our servers handle the load. We do watch for nefarious traffic. But in terms of just actual individuals that come each day, we don't track that anymore. We just track subscribers.
Okay, fair enough. And the second question is, how might the move to 5G affect StockCharts?
Well, it won't affect us directly per se. I mean, obviously, the increase in bandwidth is always a good thing for the internet as a whole and for StockCharts. We're starting, like StockCharts ACP, we're starting to provide capabilities that do require more and more bandwidth. And if consumers have more bandwidth on their phones, if they have more bandwidth at their houses because of 5G, that's a great thing for us. We're all about, if the more bandwidth everyone has, the happier we are. There are some more challenges on the phones and mobile devices in terms of screen real estate, in terms of user interface. Sometimes you really do need the precision of a mouse when you're dragging things around. But in general, we are trying to support as best we can the mobile platforms, and 5G will just continue to help us with that. Awesome.
Okay. Well, it has been a great week, and I really want to thank you, Chip, for stopping by and walking through with John. That was both those presentations were awesome. Great way to finish off the week, our finale for sure.
Well, yes. Again, I appear on the show from time to time. It has been a while, and I apologize for that. But as you can see, I've been a little busy. We're working hard behind the scenes. So even if you don't hear my voice, just rest assured that I'm working hard in the background to try and make the site the best it can be.
Sounds good. Appreciate it, Chip. Thank you. Okay. Well, let's go into. We're going to have a final market update here. I know we're running just a little bit behind, but we've had some really important things that we wanted to go into. So let's go ahead and bring that up. I do know that the market is still hanging in there pretty well. We've got, of course, jobs out today. Jobs report came out, not Steve Jobs, of course. But we've got the jobs that came out. Let me just update, make sure I got the very latest. We've got the Dow Jones currently up 22 points, the S&P up 10.5, the NASDAQ 41, the Russell 2012. 10-year Treasury yield, like earlier, still below that 20-day moving average. We'll see maybe if next week we can get a push through a couple of key resistance levels. Volatility index continues to be on the decline. That's very bullish for equities. Energy trying to make the breakout. Healthcare continuing to perform well. You can see a couple of the energy industry groups having very strong days, and there are two of your better performers in the S&P 500 in that energy space. Okay, we are going to do a very, very abbreviated version of What's Hot. And so, Mary Ellen, I think maybe we each take a few minutes. What do you got for What's Hot?
A lot of sense to go ahead. Let's go ahead and get started here with some of these semiconductor stocks. So what I have up here is the semiconductor index. You can see this big pop. It's up well over 5% for the week. A lot of positive dynamics in play here as far as why these stocks are picking up. First one that we can look at is AMD. This is Advanced Micro, and the stock gapped up here. This week we're seeing a lot in the way of analyst upgrades and speculation that the second half of this year is going to bode well for these stocks. So we can see the RSI is positive, MACD, and the stock broke out of this base. Take a look at that volume indicating more potential upside. IPGP is another one that we can look at here that is having a significant week. I like this name because it is just now popping up above that 200-day simple moving average. Your 10-day poised to cross up into a golden cross. RSI is positive, as is your MACD. So in addition to all of that, the stock is breaking out of a very nice base. We can move on to another area here, apparel-related stocks. They are very hot this week. We can look at any number of names. This is Urban Outfitters. Real turnaround. They're trying to turn around this multi-month downtrend. Still has work to do, but we could very easily rally from this 34 up to this 38. That's going to be your next area of resistance here, this downward trending blue 200-day moving average. RSI is positive, a bit overbought. Your MACD just now turning positive. One other name that we can quickly take a look at here is called Boot Barn. This is, as the name implies, they do provide a lot in the way of boots. The stock actually gapped up today, so it's up quite a bit for the week. And take a look at this volume. MACD is poised to turn positive, so I would expect this stock to excel as well. And then we can't leave without taking a look at just one of these bank stocks. A lot of them are doing well this week, but certainly one of the better known names, Bank of America. Tom talked about treasury yields going higher. Banks are going to start reporting their earnings at the end of next week. Keep that in mind. But with this downdraft, there's been a lookout for a positive reversal, and we are starting to see it in a number of these bank stocks. I'm going to leave it at that, Tom.
Okay, sounds good. I'm just going to go over a couple things as well. First of all, in the material group, we've seen a huge rise up, but I do want to point out that not all materials are going higher. Gold, you can see gold prices actually had a pretty rough week. We can also pull up silver. Take a look at silver. Silver has struggled over the course of the last really couple of weeks, but the one area is copper that has performed very well over the, really since the beginning of the year. And copper is more closely tied to economic activity. Gold and silver can be influenced by a lot of different things, but copper prices normally are going up if economic activity is picking up. So this I actually use as an economic sign. When copper prices are going higher, that tends to be bullish for equities. And we are seeing move up, sideways consolidation this week. We have seen upward movement in copper prices and a breakout. If we get through $3 on copper, I think that is a very, very bullish development for equities. Within the materials sector, commodity chemicals have had a tremendous week. Wanted to just pull up a few stocks in this space. You can see Eastman Chemical. Now, not all of of these stocks, by the way, have been strong long-term. You can see this has actually been in a downtrend, and I see a bottoming head and shoulder pattern that if we can get through $84, would be very bullish for EMN. LYB, this is another one, LyondellBasell Industries, just recently broke to a multi-month high, 2019 high, pulling back today, but overall, I like the breakout, and you can see that volume picked up to confirm. Pretty good action there. Huntsman, HUN, another one that has still got some overhead resistance to clear the end of February, early March, but we are in a nice uptrend. We've had a solid week, and a close above 25 there would be bullish. Internet stocks, last group I want to touch on. There have been some internet names, some that had been beaten up for a while, have come to life. NetEase, look at this move this week. Huge move, volume picking up after sideways consolidation. I think this is a character change on the chart for NetEase. I expect we will see higher prices. Don't be surprised we get a pullback because we are a little overbought now after this huge week, but I think that pullback will be very viable. Sina.com, SINA, another stock that really had been languishing throughout much of March, started to pick up right at the end of the month, and in April so far having a great start to the second quarter. Need to clear 69, though, on a closing basis. And then the last one I want to bring up is Baidu. Baidu had been languishing for a long time. Look at the volume coming in, though. So we're starting to see some relative strength here. We'll have to wait and see if it continues, but I like internet stocks, and Baidu starting to turn the corner here with some increasing volume, one to keep an eye on. Let's just go through some of the areas of the market that we just talked about for what's hot. I know that we went through some things very quickly, but this is a special week. We did want to certainly hear from John Murphy and Chip. And so there you have it. Those are some of the areas that we quickly covered. And we ran a poll today. So I would be very interested to see what everyone thinks as we go into quarter two. I believe that the market goes higher. So I really was most interested in the aggressive areas of the market. Which area of the market do you believe will lead? And I'm not surprised by this, Mary Ellen, but 50%, almost half of our respondents here have said technology. What do you think?
Indeed, cannot agree more. There's just so much going on. We talked earlier about 5G, the development, the need for faster speed with this data and data analysis. And it's all about the internet and mobile device use and all being cloud-based. All of that is tech-driven. So I would have to agree.
I'm going to disagree. I am going to disagree. Now, I like technology. Don't get me wrong. I do like technology, but I'm not going to be swayed by what we've seen over the last 3 months because we've been led by technology. But I do think that as we move forward, we could run into some issues with technology. Number one, I pointed out earlier in the show that technology has been a leader, and we've gotten so much momentum that a lot of times it's not surprising to see us pull back. I'm going to just show you a seasonality chart very quickly. And this is the XLK relative to the S&P 500. And you can see that as we go through the first 6 months of the year, with a little bit of an exception here in May, XLK tends to underperform the S&P 500 in the second quarter. And so I think because we've already had a run up, I think the group will do fine. I don't think it's going to be the leader. I'm going to go with my leader being the XLY, consumer discretionary. Okay, wow, what a week we have had. I want to thank everybody for joining us this week. Congratulations and happy anniversary to StockCharts.com, 20 years. I hope you've enjoyed the shows this week. I know a lot of folks behind the scenes have done a lot of work getting this ready for you. So certainly hope you've enjoyed it. Do want to thank you all for being with us. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe. We'll see you back here on Monday. Happy trading.